Right. Okay. So once again, thank you for joining. My name is Jamal Khan. I'm a senior tax partner at Churchill Tax, and I do hold these webinars regularly every month, and we do get quite a large crowd. Today we've got quite a few solicitors joining. We've got accountants. We've got quite a few financial planners, a couple of barristers joining. Quite a few barristers today, actually. This topic I've been asked again and again about how children can be used for tax planning. And I've been advising numerous clients. So I thought I'd do a webinar on this. So the accountants, the solicitors, the barristers that we have in the crowd can advise their clients appropriately. Right, so so we've got quite a few people joining, and I'm admitting people as people join, but I'm going to share my slides. And what I would suggest is that if you have any questions, if you can either save it towards the end, or you can send me an email. Most of the people do ask me questions after the session, and they send me an email. Right, okay, so I think I'm going to start because there's too many people joining. I'm wondering if I can admit people once I start sharing my slides. A second. There you go. Right, okay, I'm going to make a start. There you go. So once again, if you've got any questions, you can put them in the chat box or save it towards the end, and I'd be more than happy to help. This is a little bit about us, who we are. We do tax planning. We're quite well known for tax planning across the country. We help a lot of accountants, solicitors, financial advisors, and large businesses with tax planning, and we get instructed by barristers as well. So passing estate to grandchildren. So first of all, we've got to consider two things. Where there's income being transferred from parents to minor children. So when we say children here, this is an important point to remember, is that with children, we mean children under the age of 18. So as soon as you as soon as you turn 18, as soon as the children turn 18, they're no longer classed as children. Okay? So what we would say is that if a parent was to transfer some of the income to a child under the age of 18, that income is treated as if it was the parents, direct immediate parents' income. That's a very clear rule, and that's in the legislation and HMRC's guidance. However, that does not apply to people who are not immediate parents. It can apply to, for example, grandparents. It can apply to uncles and aunts, okay? As long as it's not your direct child. So that's an important point to remember. And the whole of this webinar for the next, I'll try to keep it short as possible, but it's quite punchy, the topic. So it's the immediate parents that cannot transfer their income to their children. It's the grandparents, aunties and uncles can. So next page. First thing that we can consider is for grandparents is to set up a junior ISA. Not many people know about it, but you can add up to £9,000 a year. If there's a wealthy granddad, Okay, or granddad has some money, or uncle and auntie have some money, up to £9,000 a year, going maximum limit of £200,000. All of that income is tax-free from the ISAs, from the junior ISAs. Okay? Not many people do that, but once you think about it, it's completely tax-free. Withdrawals are tax-free. The ISA has to stop, we call it JISA, anyway, junior ISA, right? It has to stop when the children, goodness me, 81 people. Okay. The junior ISA has to stop when the child reaches the age of 18. So what you're essentially doing is you're saying, I'm going to put £5,000 a year for whatever, £2,000, £3,000. By the time the child reaches the age of 18, they are, they've got enough money to pay for the university or to pay a deposit towards the house. And in the meanwhile, they've accumulated this income with the ISA, which is completely tax-free. Okay, it's very important. When they turn 18, it turns into a normal ISA, so it's not called a junior ISA anymore, just called the normal ISA. Just a couple of tips on the estate, passing the estate to grandchildren. So you can make annual gifts up to £3,000 in total. So you can give divided between a couple of grandchildren, as long as the total amount is £3,000. You can give wedding gifts up to £2,500 to grandchildren. But more importantly, I was just having a conversation with a client. And we were talking about different options, and then he wanted to give someone. I said, well, how much money are you earning at the moment? He said, maybe £100,000. I said, well, how much of that do you spend? And he said, well, maybe £40,000 a year. Okay, just give you an example. And so the £60,000 that he has, he can gift it to his children or grandchildren, but there is no tax to be paid on that, and then there is the 7-year limit doesn't apply on that. So it's called gifts, only gift of value from out of surplus income. Gifts out of surplus income. So you can make any level of transfer or gifts to the grandchildren. Now this is all kind of normal, this kind of stuff that if grandparents have lots of money. Where it gets interesting is when we look at things like bear trusts. A bear trust is, for example, the grandfather has some income, source of income. He can give that income to the grandchild. You can set up a bear trust for the grandchild. Essentially, the bear trust matures when the child reaches the age of 18. So if you have, for example, 4 grandchildren, best to set up 4 bear trusts. What can be better than that? Okay? And they're very easy to manage. They're not like discretionary trusts. I don't like discretionary trusts. I hate them because of the admin that goes with discretionary trusts. And when the income comes into the bear trust, it is allocated to the grandchild by the trustees, which will probably be the parents or whoever they are, the grandparents. But the income is not tax-free, so that income is taxed on the grandchild. The grandchild could be 3 months old, the grandchild could be 10 months old, 1 year old, 10 year old, 15, doesn't matter, as long as they haven't crossed 18. However, what you're getting here is you've got 4 grandchildren. That means you can set up potentially 4 bear trusts, and that's how much is the personal allowance? Usually, £4,000. I don't look at the personal allowances. How much is that? £48,000 of tax-free income. And you can use that to pay for children's school fees or other expenses for children. All tax-free. Okay. Obviously, if it crosses the tax-free allowance, you've got to pay some tax. This is a very, very important point. I mean, I've been practicing tax for 27 years now, I don't see a lot of people looking into these areas where the obvious tax savings are. Yes, people think it's complicated. Yeah, it can be complicated. You set that properly, it can be very, very useful. Right, next one. Oh, sorry, just on that. With a bird trust, they can also have the tax capital gains tax exemptions as well, which is currently £6,000. For example, we put some shares into a bird trust, and those shares are sold. There is the children will get that normal capital gains tax allowed exemption as well. Finally, partnerships. Partnerships can be the same as a bird trust. You can add children to a partnership. Yes, children, people tend to do it usually with parents. The parents doesn't work. If it's a grandparent, it does work. The child would need to be registered for HMRC and need to have a UTR number, but we can allocate the income to a partner on a tax-free basis. Or as long as I beg your pardon, I shouldn't say that. They're taxed as a normal individual. So they've got their first 12,000, whatever the personal allowance is, that's tax-free. If you've got a couple of grandchildren, you can do the maths. And HMRC have usually got no say on how much income can be allocated between a partnership, between the partners. Okay, so there's more people joining. Here we go. And we use this type of tax planning quite regularly. But when we see clients, this is the last thing on their mind. We can consider things like bear trusts and partnerships. You've got to make sure you are creating those and creating a structure very carefully, because if it's not done correctly, it can be very costly. Plus, it's very easy, once you've done it correctly, then it's very easy to maintain. Okay. That's it. Not a very long topic, but very punchy and very important and a very hot topic. If you have any questions, my contact details are here. And you can send me an email. My email address is there. You've got my telephone number as well. But if you've got any questions you'd like to ask now, I'd be more than happy to help. Oh yeah, I've got a couple of questions. Best way to pay school fees? Yeah, Stephen, you read my mind there. So yes, definitely a good best way to pay school fees or other expenses, but it's for the child, right? HMRC, so Adrian's asking, HMRC seems to make it very difficult to file tax return for a child. Yeah, but you just got to register, just get a UTR number. You don't have to have a national insurance number to get a UTR number. Okay. Any other questions? If you've got any question, you can unmute yourself. You can ask, or you can send me a chat box message, or somebody's asked a question. Anthony, Junior answered very well, but absolutely the child's at 18 to spend on a Ferrari. Yes, you've got to keep that in mind, but hopefully they wouldn't. You've got to be aware on the junior ISAs, but hopefully they wouldn't. But it's a very tax efficient way of doing it. I mean, the ISAs grow rapidly. So yeah. Okay, if you've got any other question, you can ask. You can unmute yourself. You can ask me. If not, then it's been a pleasure, and I will get my secretary to send you a recording of this session as well. Excellent. Thank you, everyone. Bye.